Welcome to TradeTheMBI.com. This is John's report is for the 11th of October. This was the day the first observation of the New World from the Pinta, from Christopher Columbus's day, was discovered. And in our current day, we found that, well, when you lower interest rates in a overly monetized situation, you have inflation. And of course, no shock. Yesterday, the print came out, and of course, inflation was higher. Now, as I've said, I don't really think the Fed has ever really targeted that 2.2% number. The reality is they would prefer something in the 5 to 6%. If you're living in the real world, you've experienced far higher inflation than that because, of course, they exclude all the things that matter, which are the things that you use to live, because why measure those? Would make no difference. But monetary easing and a Federal Reserve System obviously creating an inflationary environment, and that is exactly what it's designed to do. And as long as the deficits run what they are, you're going to continue to experience that. That's going to continue to propel the value of the indexes, even though that value realistically is diminishing in its overall return, which is exactly what happened in the 70s. And that as real estate doubled, it wasn't the fact that the value of those things became better, it was the fact that the currency used for them became worth less. And that is exactly what people are experiencing. And this is why you see the things, what they call inflation of Bitcoin or the speculation of cryptocurrency. No, it's just the relationship between these currencies that are being debased at a record rate. Have an alternative. And that's where gold comes in because it has been a currency for, well, as long as time has had commerce. And in that relationship, you can see exactly what it does. And it's going to continue to fuel things higher. Now, of course, we had a little bit of a modest slowdown, but it was bought up, relatively speaking, because at the end of the day, money is cheaper and it will continue to chase things higher. But of course, it's used to finance the deficits and make it less expensive to have them. But it does point to the folly of the Fed and their rate cut. It made no sense whatsoever, and it still doesn't. And you can see that the justification for it is non existent, other than the description that I'm describing. So when we look at it from a market standpoint, well, from a NASDAQ view, you can see shorts continuing to rise within this setup, which going to fuel another burst going back forward because at the end of the day, you're still having growth, albeit modest. The reality is the problem really stems from the fact that you're spending so much in a deficit for the limited growth that you're getting, you're not getting an effective return on that. And that's simply because it's misallocated as to its direction. It's not promoting the production of goods and services, it's just promoting consumption. And therein lies the reality of economics. You only create value in a currency when you're actually producing something, and that's not the case in this particular situation. So you're going to have these fits back and forth because of that, because it forms an irregular cycle. And the Fed has been so desperate to not have the normal business cycles that pass through take place, trying to mute them. In that muting, you get these distortions. And how the debt gets resolved, well, we know how it gets resolved. You either have to inflate out of it or at some point dissolve the debt. Those are your only options. Will it impact how things go? Well, this is a perfect example. Treasury market. We saw the ridiculous nature of where treasuries were moving, the negative yields that were being generated from it, in a ridiculous display of incoherence. And now you have the return back to some degree of sanity, still outside normal levels, but the yield having risen significantly to say, hey, yes, this was a critical error. Because the reality is inflation isn't going to be at a level that can sustain those low rates that were being offered from the treasuries, and all the people who bought those at these particular levels have basically been hosed out of their money, is the polite way to put it. Will that drive commodities like oil and some of these other things that are the driving force behind actual commerce? Yeah. And you can see oil returning back to previously elevated levels, which is only going to continue despite that inflation. And until someone or something turns the focus of things from the spending that's going on, that's all you can expect to see continue happening. So is that where protection of your money goes? Well, yeah, of course. because that's all you're doing is just protecting against the erosion of its value. From a euro standpoint, of course, that becomes problematic because they don't have any growth and they have to convert their currency into dollars to buy that oil, which is why the BRIC situation is so significant when they're able to trade outside U.S. currencies. And you can see why central governments around the world are buying extreme amounts of gold. I think it was Poland yesterday or a couple of days ago, that exceeded Britain's gold reserves. So these are all real things taking place in the real world, and none of this is a shock. Actually, it's probably more a shock that gold has been as muted as it has. You haven't seen the muted, of course. Everyone looks at the way Bitcoin and that have been trading now, but when you look at the overall elevation of it from its modest beginnings, it's quite a significant store of value outside of the regular currencies. You can see that many of those that are at least viable will continue to prosper within that, but they have quite stabilized overall. And until the next big spurt of inflation takes place, which is coming, don't fool yourself, it's coming. May not show up until the beginning of next year, and certainly will have definitely an impact on who gets elected, how that's going to continue. But there are very simple policy things that can be changed to abate it. The question is, do they want that? You see, and therein lies the question: is it really something, despite being spoken, is it really desired? From a 50K standpoint, you can see we got pretty much stuck between the 76-100% range. You had a mix of the magenta leading, then NBI white taking over. Those muted moves from the NBI white on the spikes show limited progress. We're potentially facing another magenta closing below. That one you would expect to move to the 50%. A failure to do so, you would expect that big move of relatively new highs. And you can see from a shakeout standpoint, it's gotten quite murky in the move to the zero line in that. But as long as you're still holding up above these, 76 point and definitely above the 61, you're in good shape. It's not horrible. It's just the normal flow of options and how it affects overall value. And so in this particular case, you can see from the 5-minute chart intraday, you had the spike up. Of course, they had to mute that. Brokers flipping back to the opposite side of it to put, bring puts into the play. Then they get to a point where those are overdone, and you flip around back to the call side of it and end up fairly neutral for an overall day. But you certainly eat a lot of that time, money, so to speak. You can see here in the pre-market, and of course then there's world events that we still have unfolding. Israel has not done its retaliation. Will that be muted? Will they even do anything? And then the conflicts, of course, in Russia, and that continue. Hurricane situations in America, and then of course the election. So there's just a lot of back and forth at this particular stage, and the beauty is it's all pretty clear from our paint order readings and from the NBI setups that we have. So just continue to play it from there. As always, though, anything relevant, I'll put it on the Skype chat. Have a good one. Trade well.